Welcome, ladies and gentlemen, to Commodity TV and a new edition of our interview presentation series. And it's my honor and pleasure to welcome today Calibre Mining. You remember they are extremely profitable and successful gold producer out of Nicaragua and also in Nevada. And with us here is Ryan King, the Senior Vice President, Corporate Development and Investor Relations. Good morning to Canada. How are you, Ryan?
Oh, good morning. Thank you. Thanks for allowing us to be here, Johan. Very, very good to be here.
Yeah, thanks for taking the time. And honestly, I appreciate also that you have the time for us because I am a shareholder of your company. I have to disclose that also first to make sure that nobody gets angry on me. And no, I'm really happy because I saw your Q2 numbers. They were extremely well. I saw that you guys are making money. You have no debt. You have $92 million in the bank. Those are all things these days in a world which is more and more unsecure, which we really like and appreciate. And I would suggest I bring up the presentation and you get started and I will ask my questions in between.
Sounds good. Yeah.
Great. So Ryan, please.
Sure. I'll just advance a few slides here and you know, just for the audience and for your listeners and viewers. Yeah, Calibre is a multi-asset gold producer. This year, as you can see, we've guided the market that we're going to produce between 220 and 235,000 ounces. And year over year, over the last couple of years, we've seen a gradual and organic production growth increase of approximately 30%. And what's exciting about us, as we've announced in June, is that we're also seeing future growth in 2023, increasing gold production, 2024, increasing gold production, all based on higher grades going into our mills, which should lead to lower costs. So that's exciting. And as you said, you know, a very strong balance sheet, no debt, 92 million in cash, which is allowing us to self-fund all of our growth. It's self-funding our exploration, our mine development to increase our production. And this is all from a team that has done it before. You know, this team has developed mines, has sold assets, has merged companies. Actually, the last company we did was New Market Gold that was very successful in its merger with Kirkland Lake. It went on to increase in value significantly. So that's our goal, is to create shareholder value. Obviously, in this environment, you know, gold's up, gold's down, but we keep our heads down and continue to execute quarter over quarter and invest in the drill bit, and that will be successful for us. I'm sure of that. You know, here we are trading at a pretty significant enterprise value to ounce production discount to our peer group. And, you know, so I believe that there's an opportunity that over time, as we continue to execute, build up our mine life, build up our reserves, continue to produce quarter over quarter like we've been doing and meeting or beating expectations, that we will get to be a higher valuation like our peers. And I think some of the things that lead to that are success with the drill bit. And we'll talk a little bit about that in the presentation, which I think will benefit us.
Yeah. One question, Ryan, why do you think you are still that in let's say, regard or respect to your competitors, if I would call it like that, why do you think you still have such an undervaluation? Is it because of Nicaragua that maybe investors are a little bit feeling, not so comfortable, but on the other hand, you guys bought into Nevada with producing assets, so that should balance that a bit, right?
Yeah, I think so. And, you know, as an investor looking at commodity companies like ourselves, you're looking for mine life, you're looking for costs and see what those are, and jurisdiction. And, you know, we've been increasing our mine life. We've seen over a 250% increase since we acquired the assets and reserves in Nicaragua. We've executed quarter over quarter. We've obtained all of the required permits that we need to on a regular basis. So I think we're really starting to prove ourselves that we can execute there. And it's, you know, from our perspective, a safe and effective place to operate, as we've proven. So I think you're right. It's partly that. So that you know, as we continue to execute, I think that will kind of fall away and people will see that we can deliver on expectations.
Okay.
Yeah, so unlocking value and building a future here. I'll spend a little bit of time on a couple of the charts here to start with. You can see the charts on the top right-hand corner. As I mentioned, we've increased our reserves quite significantly since acquiring the assets. You know, that's a bar chart year over year of reserves at Limon and Libertad. This is the highest reserve base these assets have seen over the last decade. And particularly in the line chart there, it's the highest grade. 4.6 grams per ton gold is the average reserve grade. So, as I mentioned, we are seeing a grade-driven production increase year over year in front of us. So a very exciting time for us. And, that's because we've kept our head down. We've continued to invest in the drill bit. We are having success there. And we are having particular success at our Limon property recently, which I'll talk about, where we've made a new very high-grade discovery. It looks like it's got a lot of potential. But just quickly on the unlocking value here, when we acquired the assets, the Libertad operation was heading towards closure, right? And the Limon operation was going to be the only asset in production, going to be producing about 50 to 70,000 ounces a year. But now, as we've just discussed, Libertad is in production. Limon is in production. We're guiding the market 180 to 190,000 ounces of production just in Central America, right? So a total of 220 to 235. So a significant unlocking of value since we've acquired the assets. We've added over 1 million ounces of reserves at the highest grade, as I've just mentioned, since acquiring in Q4 2019. We've increased cash very significantly. We've paid off all debts. And of course, we've just this year acquired the Nevada assets, producing Nevada asset from Fiore Gold. Again, Q2, another strong quarter for us. Year to date, our all-in sustaining cost, $1,244, right within our guidance range of $1,200 to $1,275. Mm-hmm. The first half was always set to be a little higher cost and a little lower production. You can see there our year-to-date production was 111,000 ounces, which, if we did that again in the second half of the year, we'll meet the lower end of our production guidance. But we have expected that the second half, due to mine sequencing and grades coming into the mills, that we will be likely higher production and lower costs in the second half. And we'll talk a little bit about that more in the future due to some news recently that we announced about an equipment failure we had at our Libertad mill, which we anticipate will have probably somewhere around a 15,000 ounce impact, a delay, not a loss, but a delay of timing of those ounces coming into production. Mm-hmm. But still a very strong quarter for us. All, between 8 or 9 analysts that cover the stock, we met expectations across the board. So that was a good thing, considering a lot of our peer group, higher costs, lower production, increasing guidance on costs. Obviously not a good thing in this market, but a difficult time with all the inflationary pressures that we're seeing. But we hit the numbers that were expected of us.
As you said, you had that failure in your, I don't know, was it circuit material machines, whatever. Is that something which is, let's say, a little bit unusual? Was it just like due to the weakness of a machine or material loss? Or is that something which we can expect in the future also because the machines are old? Or is that something which just happened?
Yeah, unfortunately, it was an equipment failure in one of what's called a strip vessel or a tank. These things do happen. Fortunately, we have two in the circuit. So one has failed. We're now going through all of the testing to check the second circuit or the second tank to ensure that works efficiently, safely, and we can bring it back into operation here, probably between now and the end of September. But we're just getting outside specialists to test all of that. So yeah, these equipment failures do happen. There was no environmental incidents. Obviously, there was no injuries. So this is a good thing. And again, this is a matter of delay, not a loss. So once this gets back up and running, the mill is running, the mining is operating. So all of the activities are happening. We just can't pour doré bars at the moment. We can produce everything and it's in the circuit. It's this little part of the circuit that is down at the moment for repair. So these things do happen, right? Mm-hmm. So just continuing on here, as I already mentioned, we've got a significant exploration program underway, 170 kilometers of drilling between Nicaragua and Nevada this year, all self-funded, right? As we mentioned, where not only are we self-funding mine development and self-funding all this exploration, but we're adding cash quarter over quarter as well. So a real positive for our company.
What is the profit per share?
In Q. Now you're really taxing my brain here. I should know this off the top of my head.
Yeah, but it just came through my mind because you have cash per share 27 cents. I mean, that is of today's share price. That's already 28% of the valuation. That is crazy.
That's right. Yeah, I mean, we have our cash position on a per share basis is pretty significant, and our market cap is approximately 400 million. So we're in on a really strong position from a balance sheet perspective. But in Q2, I think our earnings per share were 3 cents. So we're earning, even after all the investments that we're making into the business.
So could we say like earnings per share for this year, maybe in the range of, let's say, between 10 and 12 cents easily?
It all really is going to depend on the gold price, and obviously.
Given the gold price flat, let's say 1,800 for the rest of the year.
It's going to be somewhere in that range for sure. Absolutely.
Yeah, no, because then you guys have like a price earning ratio between 8 and 10. That is not really expensive with no debt and 27 cents cash.
Correct. Yeah, no, that's right. And as we said before, our production growth is increasing year over year for the next couple of years due to grade. It's not volume, it's more grade related. So, that should have a positive impact on our costs, should have a positive impact on our earnings. So, pretty exciting looking into the future.
Yeah, and if I understand that correct, your production growth, you must not invest hundreds of millions. You can use the machinery you have already. I think that's super important, right?
That's right. These are satellite deposits that we're bringing online. As I mentioned at the beginning, we're getting permits. We're doing all of the public consultation work, making sure that we're engaging with all of our communities and stakeholders. And, we're getting these permits for approval to develop these satellite mines that we then haul over to existing infrastructure, right? To your point, we have existing infrastructure that has surplus capacity. Now, we obviously have to invest in all of that work leading up to developing these properties. You need site infrastructure, you need roads and power to those sites, which we bring online, but it's not hundreds of kilometers, it's a few kilometers into off of main highways and arteries. So to your point, we're talking about millions of dollars versus hundreds of millions of dollars
exactly.
Production and utilize our infrastructure.
Yeah, super.
I'll probably go to the next slide now and maybe just quickly overview our operations in Nicaragua. As we've been talking about, we've got a mine and mill at Limon, and that was where we anticipated there was only going to be production when we originally acquired these assets, right? The Libertad facility was heading towards closure because at the site, there was very limited resources and reserves. But fortunately for us, we've got a CEO who operated within the Newmont organization for over 30 years, and his role was to look at operations and try to find ways to optimize them. And you can see here what we're doing now is we're not only mining and milling at Limon and filling that mill, but we're actually taking surplus resources, putting it in a truck and hauling it over to the Libertad facility for processing. So we're utilizing efficiently the installed capacity that we have. You see, we've got a much larger mill at Libertad and a smaller amount of resources on that site. And then we're utilizing the mill to haul Pavon material as well and Limon material as well. So that's where we're seeing the production growth, utilizing good infrastructure in country, paved highways. And then the next one we're developing is Eastern Borosi up in the north end of the corner of the country. High grade, 6.8 grams per ton gold in an open pit. So very exciting to bring that on stream in the second half of 2023. A little bit on, some of our concessions and exploration. You can see the red there, all of the concessions that we own. You can see Libertad is here, Limon here. Those are obviously where our two mills sit and production facilities for producing and pouring doré bars, and then all of these exploration concessions that we have that we've staked and are now advancing, some of which we're starting to drill on up in Eastern Borosi. We're we're advancing that project, as I just mentioned, drilling at a number of targets there. Pavon is an open pit. Right now, we're mining the Pavon Norte open pit. We just recently got approved for the Pavon Central open pit. And what's exciting about this is that Pavon Norte was a 3-gram open pit ore body. We put that in a truck and haul it to the Libertad facility. And it's been working very well for us for over the last 2 years. Now we're beginning to develop, and next year we'll be mining Pavon Central, which is 6.5 gram per ton gold average. So double the average grade. Hence the reason we see a grade-driven production increase in going into the Libertad facility. So that'll be very positive from a production and cash flow perspective. And what I'm quite excited about is the La Fortuna and Buena Vista concessions. These two concessions, we've been doing a bunch of mapping, sampling on these properties, and they're showing some new low sulfidation epithermal vein targets. So we're quite excited to get in there and start drilling those earlier stage targets. But nonetheless, they're looking very analogous to some of the other low sulfidation systems that we've drilled and been successful on. So yeah, lots of exploration potential within Nicaragua. We'll zoom in a little bit here now and look at our Limon property. And what's exciting about Limon is after decades of operations, exploration, and production, over 3.5 million ounces of past production on the property, we are continuing to find more gold. And what we're looking at here is a VTEM airborne geophysical map. And so what, I'll just point out very simply is past production along these contacts between the high-low resistivity. So Santa Pancha, it is currently in operations. A small amount of gold comes out of there for us, an underground mine. But over 1.3 million ounces of gold has been produced along this contact. Very limited drilling up to the north. And this is new information, right? We flew this airborne survey and got this detailed new geophysical data. And then we started to overlay past production where current resources are, as you can see on the slide here. We started to recognize, hey, along these contacts is where we're finding gold and where gold has been produced. So what's exciting is that we've got a mine here called Pantheon, the Pantheon vein here, which is currently in production. So we're mining that now, and I think our average grade out of there is about 7 to 8 grams per ton gold. So good grade coming out of there, going into our mill. And then less than a kilometer to the north, as you can see by the call out here, we've started to intercept some very, very high grades. And these were announced back in May. We started announcing these results, 17 grams over 7 meters. In June, we announced 66 over 5, 30 over 5. So again, following up on that initial success. And actually most recently, just this week, we announced again some more very high grade results from that system. 26 grams per ton gold over 8 meters, 53 grams over 3.8 meters. So the system is continuing. And what you can see here visually is that to the northwest and to the northeast, you can see along the potential extension contacts there, that's all exploration potential, right? We have not gone in there and started drilling there yet, but we now have 4 rigs testing along strike up there.
Ryan, to what depths are those fantastic results?
So yeah, that's a really good point.
Approximately.
Still about 200 to 250 meters from surface. So it's still very shallow. So very exciting opportunity for us. Again, extremely high grade. I mean, if you looked at this and averaged it out right now, you're probably 10 to 15 grams per ton gold. So that's a pretty meaningful new discovery for us. And as you can see visually on the map, it looks like we've got a lot of potential to find more ounces along that contact to the north, northwest, and northeast. So pretty exciting for us, and that's where a lot of our attention is at the moment on exploration.
But you said you're already producing at Pantheon now, so that means the infrastructure is there. You can fully benefit from those results.
Well, this is correct. We're actually producing from Pantheon, not Pantheon North, but Pantheon. Okay. So this is but you're absolutely right. We're only about a kilometer away from underground development infrastructure. at Pantheon to Pantheon North. So absolutely, from now to getting that into production, it's not millions and millions of dollars. We've got the mill right in the middle of the page here. We've got underground infrastructure on site, so everything we need is there. We're finding more to feed into the mill at higher grades.
Super, great.
I won't spend too much time on this, but what it is that currently today we fill our Limon mill and our Libertad mill. We currently only have about a 50% utilization on that mill right now. So what's exciting about this is that, assuming we have more exploration success to increase the utilization of that mill, you can see, at 3 grams in the first left bar, 4 grams in the middle, and 5 grams, our average grade of reserves is 4.6 grams. But if we get up to 100% utilization just from the Libertad mill, you're seeing about a 260,000 ounce annual production. So an incredible opportunity. Remember, our guidance this year in Nicaragua is 180 to 190,000 ounces. So there's great potential here with installed infrastructure. We talked a little bit about this. We acquired these Nevada assets in a transaction with Fiore Gold earlier this year. So Fiore has 2 primary assets in Nevada: the Pan Gold Mine, which is a 40 to 50,000 ounce a year heap leach mine, which is currently in production and producing for us. We've also been investing heavily in exploration at Pan. And then the Gold Rock project, which is located only about 13 kilometers away from Pan. It's federally approved. So we're now working through state permits to advance that project. We're working through technical studies. We're working through a bunch of infill drilling and step-out drilling at that project as well. So we anticipate to be in a production, making construction decision probably this time or Q4 of next year at Gold Rock. But it is looking like an exciting opportunity for growth.
I think you had also some good drill results from the Pan Gold Mine, and it looks to me a little bit like that you might extend also there the mine life for Pan, plus then in addition you get Gold Rock. So I don't know, because we just saw 6.5 years you are planning for Gold Rock already, but I know there's more exploration potential, as I know Fiore, the old Fiore, quite well. So it looks to me like if you are drilling, let's say, a little bit more, you can easily produce, let's say, maybe at least for the next 6 to 10 years out of that, right?
Well, we absolutely, we think there's great potential. Now, we don't have updated resources and reserves at Pan yet, but, between 380,000 ounces that is there in all categories now, and with this drill program, as you can see here, evidenced by, excellent grades and widths, the average reserve grade there today is 0.4 grams per ton gold. And we're seeing better widths and better grades in certain areas of the deposit. For example, Pegasus, which is a zone here down at the South Resource Pit area where we're currently mining along the edges, 1 gram over 50 meters. That's significantly higher grade, even though it's, not in context of Nicaragua, but it's much higher than what we've been doing. But it's a lower cost operation, right? It's a lower cost to heap leach. It's not a big milling operation. So you can afford lower grade oxide material.
Do you plan, let's say, over the next 2 or 3 years, let's say, to raise the Nevada production, or do you think that you leave it like around the 40,000-50,000 ounces level?
Yeah, it's a great question because and at this stage, it's really going to depend on what the scope and scale of Pan ends up being after all of this drilling, right? We're doing 50,000 meters at Pan this year, and upon doing an updated technical report, which will come out in the first quarter of next year, an updated resource and reserve, we'll have a better understanding of what it is that we're dealing with, and then what we can do from an optimization perspective, because there are things, right? Pan currently is a contract mining operation. We can look at secondary crushing to liberate better gold recoveries. We can look at conveyor stacking to reduce costs. So there's a number of things that we can do. Yeah, absolutely, at Pan. So we'll have to wait and see how the resource shapes up after only 1 year of drilling by us. But what's exciting is that if you look at the last 4 years, the average amount of drilling has only been approximately about $1 million to $1.5 million invested into Pan. whereas this year we're almost spending 10, right? So I think it's going to have a meaningful impact. Based on the results we're seeing here, I think it's going to have a meaningful impact. And then you layer on another 40 to 50,000 ounces plus from Gold Rock, you know, assuming that comes online when we expect, you'll see a doubling of production. And then, yeah, I think there's very good potential to extend mine life here.
Super. Fantastic.
We talked about Gold Rock here, but one thing I wanted to zoom in on here is currently where the resources are in blue in the center of the page there. And then you see a bit of a dotted line around that. That's the federally permitted area. The blue area in the middle there, that shape is the resource of almost 500,000 ounces in all categories. So we've been focusing within that federally permitted area this year, right? Because our goal is, okay, get that into production or make a construction decision at some point in time, get that into production first, and then look at the exploration potential outside of the permitted area. It's easier to amend down the road, assuming all of the environmental work gets done obviously properly and it checks the box, than it is to wait and restart permitting on a project that's much larger than what it currently is sitting at now. So that's our goal right now. We are having success with the drill bit there, as we've announced a few set of results. We've also announced some metallurgical results. So in the oxide zones at Gold Rock, we're seeing a minimum of an 86% recovery, up to 96% recoveries. So really good recoveries at a heap leach only operation. You know, in the previous slides there, we talked about the past PEA that Fiore did. They were looking at something called a vat leach and a heap leach, but this will be only a heap leach operation. That's what we anticipate at this point in time. I won't talk too much about this. We've talked a little bit about our guidance. Investing in the future, 220 to 235,000 ounces, generating cash, reinvesting back into the business. The third asset that came in the Fiore transaction was a project called Golden Eagle in Washington State. This has optionality for us. You know, we think there's potential here. You look around, we've got Kinross nearby, we've got Hecla nearby. There's activity happening. Kinross has made a new discovery at the Buckhorn mine. So we're reevaluating this Golden Eagle project. It's a 2 million ounce measured and indicated resource. We think again that there's optionality here and potential, and some good grades in some of these historical drill intercepts. So we're just undertaking an evaluation of the project now to see what the best next steps are, considering we're investing heavily into Nevada and Nicaragua at the moment.
But that could be, let's say, over the next 5 to 8 years, something you might develop by yourself, or maybe with your neighbors.
Absolutely, absolutely. As I said, I think that there's really good optionality here, especially with the fact that neighbors are in the area doing exploration work, looking at things from that perspective. You know, we're sitting on the largest resource base in the area, so I think there's really good potential. So that sums it up. 220 to 230 this year, going up to almost 300,000 ounces of production by 2024. Still have surplus capacity at our Libertad mill. And for me, what's one of the most exciting aspects of the business today is that we've found a very high-grade discovery at one of the operating mine sites. And it's early days there. There's good exploration potential. We've got a strong cash position. We're able to self-fund through cash flow. And the company has no debt, so a really strong financial position to be in.
Super. Question, as I see, we see a really growing production profile you have, and I mean, you want to grow the business by approximately 25% over the next 2 years. So would the growth in production balance a little bit the inflation cost-wise?
Well, yeah, I mean, it's interesting. I mean, during our second quarter conference call, we talked about inflation, and we have been feeling the inflationary pressures in reagents, in diesel fuel, etc. But since then, actually, inflation, particularly the fuel pressures have come off quite a bit. You know, we were up to 120 WTI oil there during the second quarter, and here we are at $80, $85 a barrel now, right? So we're already feeling the reduction of some inflationary pressures. I assume that will continue with what the central banks are doing to try and bring down inflationary pressures. It's going to take some time, there's no doubt. But what's really going to help drive that the cost profile for us is going to be grade hitting the mill, right? So, and yes, we do have to haul different distances to get it into that facility, but grade is king, and so we see an increasing grade profile over the next couple of years as well, which will help us.
Super. So that means you think you can balance that. I mean, we saw from January, like in the world, I think we were at 1,030 average costs. Today we are at 1,260 already, I think, as an average. So that's a good $200 move. But if I look at your costs, you are just in the world average, I would call it. Yeah, if I do all your production facilities, I put them together. But with that growing production, I could imagine, let's say, easing the inflation a little bit, that you can hold it. That's my feeling.
Yeah, no, that's right. I mean, with the increasing production, it's coming at a grade perspective, not so much a volume. So it should help us on an operating cost basis, yes.
Yeah.
And then help offset some of the inflationary pressures.
Yeah. Okay, last question. Whoops. Last question. When do you think you start to buy back shares? Because it's so dirt cheap.
Yeah, you're right. It is very cheap, and I think that at the moment gold seems to be somewhat out of favor. I think that's going to change. I think you look at the debts of the world, the inflationary pressures going on, the geopolitical situations around the world. I'll tell you, over the last couple of weeks and months, we've seen the dollar rising and rising and rising and hitting all-time highs. It's been unbelievable to see this, and gold has always been inversely related. It cannot continue having that dollar go higher and higher and higher. It's going to create a deflationary environment for the U.S. But, we're still at $1,700 per ounce U.S. gold. So when the dollar starts to roll over, I think gold's going to have a real uptick here, and it's just a matter of time. Obviously, don't know what the future is going to hold, but yeah, no, it's an exciting opportunity. So we'll see how this goes, but we're continuing to invest in the business. We see that's for the time being, building up resources and reserves, having success with the drill bit, discovering new high grade zones. That's going to have a real impact for us when the market starts to look at gold equities again.
Exactly. Super. Yeah. Time to get to collect Calibre Mining shares, because as said, below $1, Jesus Christ, that is really cheap. I bought personally at 93 cents again, which I think it is a bargain. And I'm totally positive on the gold price. So from that perspective, everything is going right. You guys do a great work. Thank you very much for that. And please really pursue your paths without any debt and making money, also making money at $1,700 gold. That is fantastic. And just execute your growth plan, I would say. Ryan, thank you very much for the interview and for the interview presentation especially.
Thanks very much for your time. Always appreciate being here, Johan.
Thank you very much. Yeah, ladies and gentlemen, that was Ryan King, the Senior Vice President, Corporate Development and Investor Relations of Calibre Mining. And I think you heard it. That company is doing extremely well, has a plan to execute on the real growth path. They want to bring up the production by easily 25 to 30% over the next 2 years. And I think the costs are really under control through that. On the one hand, on the other hand, they have no debt. So they have enough firing power, $92 million in the bank, and they are making money. That is also very important. They can self-finance their 170,000 meter drill programs. They have a lot of drill rigs going on. Nevada is running well. Nicaragua is running well. This is how we want to have it. The only thing is the valuation is way too low, but this is great buying opportunity. Those are the opportunities we love to have in the markets, and I would suggest you have a very, very close look on Calibre Mining. I'm a shareholder. You should maybe do the same. Thanks for watching us. Bye-bye from Switzerland.